In the next 30 minutes, I'm going to teach you every SMC concept that you need to know in order to become a profitable trader. The truth is, I wasted years trying to trade all of these different SMC or ICT concepts that you find online. And it wasn't until I simplified everything and locked in on only the few real SMC concepts that truly made a difference that my trading changed completely. To the point where we fast forward today, I'm able to consistently generate money from the markets like this, and this on a consistent basis. And it's all thanks to the concepts that I'm gonna share with you in this video. And as a bonus, I'm gonna tie all of those concepts together into a step-by-step trading strategy that you can follow along with at home. The core concepts that I'm gonna be sharing with you in this video are as follows. The first one is institutional supply and demand. Secondly, is going to be mastering market structure. And finally, we're going to be talking about liquidity concepts. And then, as I said, after that, we'll combine all of those three concepts into a step-by-step trading strategy, and I'll even show you a trade breakdown. Throughout this video, I will share with you the theory behind the idea using the line charts like this one. And then after, I'll share with you the actual lesson on the charts themselves. So you'll understand the concept and the concept in action. Starting with supply and demand in a bullish scenario. Very simply put, supply and demand is what controls the price of anything. Forex, indices, futures, anything that you can possibly think of, supply and demand is the reason that price moves. And here's how it works. Price moves from areas of balance to imbalance. What is the difference? Areas of balance are when price sits steadily inside of a price range. What this means and what it shows you every time you find a range, it shows you that price is currently in acceptance, meaning a lot of transactions are taking place between buyers and sellers at one price point. This is fair value. Then what happens is price goes into discovery phase. Once transactions slow down on one side of the market, price is then able to shoot up into a different direction. This indicates an overwhelm, an imbalance between supply and demand. So in a scenario where you have a range and then you have a bullish expansion, what that simply means is that supply has become short, so sellers have become weaker, and demand has increased. So demand has controlled price. That is why price is going to seek new sellers. That is essentially what's happening. In here, buyers and sellers are both transacting pretty equally. Then sellers step out of the market because there aren't as many left. Buyers are continuing in the market, and so price has to go and find new sellers to match buyers. That is why price increases. Then what happens is the market becomes out of balance. So you'll notice that price will leave behind these gaps in price. What usually happens is price will re-gravitate back toward this old previous area of supply or demand, react from this level, and continue trading higher. This is what you will see time and time again. And so this in here, this range before a heavy move, is what we call a demand zone or a supply zone, or in other words, an order block. Here is a bearish example of this exact same thing. We see buyers and sellers fairly agreeing on price. Price is contained inside of a range. Price is not able to break out. That means there is a pretty equal level of supply and demand, a pretty equal level of bid and ask orders. And then what happens is demand will probably step out of the market, or a large amount of supply will enter the market. This imbalance causes price to shoot down because the supply needs to go and find demand. In other words, sellers need to go and find buyers. And if there are no buyers at this price point, price will keep dropping until the amount of supply that's entered the market will balance out with the amount of demand. It is literally that simple. And then usually what happens is when you choose the right areas of supply and demand, institutional areas of supply and demand, price will come back to these areas, respect them, and then trade away from them. The logic behind this is also very simple. What happens is, in these ranges that we have, these are the perfect loading phases for an institution. Now, this might be a little bit advanced, but don't worry. Essentially, let's say you have an institution, and that institution's goal is to transact 10,000 lots of euro-dollar. So large institutions, hedge funds, multinational, whatever they may be, these large institutions have set targets. They need to transact certain amounts of volume at certain price points. So let's say an institution comes into the market and they want to sell 10,000 lots at a certain price point, right? Let's say it was 1.14400. That's their target, and that's that price in here. What happens is, if that institution tries to come into the market and immediately put all of those 10,000 lots in a sell, there may not be enough demand, meaning there may not be 10,000 lots available from buyers at this specific price point. So what price does, this is how a price auction works. What price does is price will fill as many as it can at this price point. So maybe it's able to fill, let's say 1,000 lots because there is 1,000 lots of demand at this price point. Then what will happen when the demand runs out, price will then drop down to the next level, which may be 1.400, for example. And then there might be another 1,000 lots at that price point, which is, let's say here. Their next 1,000 lots will transact at this level, and so on and so on and so on and so on until price eventually reaches an area where all of these lots have been transacted. Now, because of that, institutions don't just come into the market and dump all of their order at one price point, because they know if they try to put all of their liquidity in at one time, they'll get some in here, but then they'll get more in here, 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 and here. And by the time this whole order has been complete, their average order value, their AOV, is not what they wanted. They wanted this average order value, and their average order value ends up being somewhere down here. That's a failed trade, and that is lost money for an institution. So what institutions do is they find these areas where buyers and sellers are accepting prices, and then they will slowly but surely put their orders in here. So they'll put 1,000, and then those orders will get absorbed, and then they'll put in another 1,000, and they'll get absorbed, and then another 1,000 and they'll get absorbed. And then what happens is when the demand is gone from the market, they will wait. They won't force price because they will send price down, right? So what they'll do is they'll sit at this level and they'll wait for price to return. So far, they have filled 3,000 lots at this level, let's say, for example. Then what happens when price returns to this level, then they will start transacting again. And they already have pending orders at this level. So when price hits this level, 1,000 lots gets traded, 1,000 lots gets traded, 1,000 lots gets traded. And that is why we call this an order block. So an area of institutional supply or demand is referred to as an order block. An order block simply means an area of price that is blocked with orders. That is literally what an order block means. And so when price gets into this level, buyers are trying to push price up and they're trying to push price through this level. But this area is blocked. Right? That's what it is. It's blocked because this institution didn't get their full transactions in at this price point. So they've still got orders in here. So when price hits in, they get blocked with those orders and buyers can't push price through. That is ultimately an order block. And then what you'll see is the buyers will get exhausted and price will begin to trade lower and sell off. Here's an example of how that would look like from a candle by candle basis, right? What you might see is an area of price, depending on what time frame you're looking. And then you'll see these heavy drop-offs. And then you might see another area of price. So what we have here is two different time frames. On one time frame, we see just 3 candles. On another time frame, we see all of the moves inside of price. And this is what that looks like. When you see this 3 candle formation, if you drop down to a lower time frame, inside of that lower time frame, you'll be seeing a range, aggressive sell-off, and then another range. Then what happens usually is price will revisit this area and then trade away from it if you've chose the correct level. Here's a bullish example. We range and then we get a bullish expansion and then we'll enter back into another range. This here is what you would look at as an order block. On a lower time frame, it's a range continuation and this is the order block. Then price will likely come back into this level and then continue trading higher if you choose the correct levels, which is what I'm going to show you in just a moment. So here we are on the daily time frame. And what we can see here is we have a aggressive expansion toward the buy side. But just before that, you can see we have this order block in here. If we drop down the lower time frame, we will see, let's say the 4-hour time frame. What you'll notice is that we have exactly what we just spoke about. We have a range and then an aggressive expansion. This is where institutions are able to load up their orders in this price point. And then price goes into discovery. It goes into expansion. This becomes our area of demand, or on a higher time frame, it would be an order block. Now you can see how on one time frame, it might look like a range and then an expansion. And on a different time frame, it could just look like a 1 candle move like this. It's the same thing, just understood contextually from a fractal perspective. Now look what happens. Price starts approaching back into this level because this area is inefficient. Price starts rebalancing. Price hits this demand zone and immediately starts transacting toward the buy side. Then notice what happens again, right? This happens on a large scale and on a micro scale. In here we have range, expansion, right? Big bullish expansive move. And what do we leave behind? This range. This range also becomes our demand zone. And then price continues. So you'll notice that price is always doing exactly this. It's going range, expansion, range, expansion. These ranges before the expansions and the range with the expansion is a clear indication of institutional supply and demand if they are traded contextually to the trend. This is a very key point. Notice here that we have also a range and expansion. And then when price comes back to this level, yes, it does have a reaction, but then notice that we eventually trade through that level. That is because we are not trading in alignment with the trend. The trend is bullish. So we should be expecting bullish continuation. In here, this is a bearish area of supply. So this level will not hold. There's a big difference between institutional demand and supply that works and that doesn't work. And now I'm going to walk you through what that looks like from a market structure perspective. Now, just before we move on, I need to stop you for 1 second and tell you something that I wish somebody had told me much sooner. You see, concepts will only take you so far. There are many traders out there who know all the concepts in the world and still struggle to make any money from trading. There is something more important. There is edge, there is systems, and there is one's trading psychology. And so after you finish this video, because again, concepts are extremely important. After you've finished this video, I've left another video for you down below this one. You can click the link in the description. It's going to take you to another video just like this one, 45-minute free masterclass, giving you everything that you need to become a profitable trader, not just the concepts themselves. I hope you really do enjoy it. The second smart money concept that is imperative if you want to be successful is market structure. As I just walked you through, not all supply and demand is the same. Supply and demand is a very powerful tool, but if you don't choose the right direction for your supply and demand, you will constantly be choosing the levels that don't work. And so what you need to have is market structure. Market structure is a very simple and easy to use concept. It's simply using the external swing points of price action to give you a clear understanding of the trend. And then that market structure will give you a very clear understanding of where price is likely to go to next. And the whole concept of making money from trading is understanding what is going to happen next and how we can make money from it. And market structure is genuinely, hands down, one of the best concepts that you can use to understand what's going to happen next. And so again, market structure is simple. We just find these swing points. Notice that this is the low of price. Price comes up in here and it creates a high. We know it's a high because price reverses from this level. We get up here and then we reverse. So this becomes a high. So we have a low and a high. Price continues down here and then it reverses from this low. And so this swing point is a low. Notice that this low is higher than this low. This is an indication of bullish structure. This high, price continues up and puts in this high. Price reverses from this high. This is a higher high. This is a break of structure, a break of structure. This is a higher high. This high is higher than the previous high. So we have higher low and higher high. That is bullish structure. So at that point, the institutional direction is bullish, right? The best way to make money is to trade with the trend, to trade with the big boys. Then we get a higher high. Then price comes down and we reverse, right? A higher low, higher high again, bullish structure. Then what happens, and this always happens at some point inside of a trend, you get a change of character. So we were bullish, we had a break of structure, now we become bearish and we have a change of character. Change of character is very simple. We shift from bullish to bearish. The way that we know that is this is the low right here that is in control. This is a strong low. It's a strong low because it breaks a previous high and puts in the highest point of the price at this moment in time. This low is in control of price. If that low gets broken, this becomes a change of character. Now this is the high and this is the low. And that is what's in control of price. Swing low, lower low, right? This low is lower than the previous low. So we are bearish. Then we're expecting price to put in a swing high, and then a lower low. And so if you're coming into a market right now and this is what you're seeing, what do you think is likely to happen next? Now you know that this is my high and this is potentially my low if price reverses from there. So what you would be expecting at this point in time would be a pullback like this one, and then a continuation like this one. That is what you'd be expecting. You'd be expecting price to put in a new lower high and then a new lower low. And all your job is to try to find this high and try to sell at that high and take out this low. Like, trading is that simple. And that is why the structure is so important. The thing is though, is you need to understand when this high will be, because sometimes you might get something like this, right? And all of these highs were fake highs. That's why we use supply and demand. Because what you'll notice is somewhere in here, there might be a range and sell off, which will give you your order block. And so you know now if price comes up here and starts reversing here, well, that's a fake high because we haven't hit this supply yet. So price will come back up. So many traders get trapped on this level. And then again, price might start trading lower and traders are trying to sell this level, but the supply zone is here. And so you need to wait for this level, and that's your trigger. That is why we use supply and demand. So that's market structure V1. This is market structure V2. And this is what market structure will actually look like. Now it looks confusing, but it's no different to what we just looked at. We have a low in here and high. Price reverses from here. Now, here's the difference. This is a low, correct. This is a high, correct. This is a lower low, correct. But all of this is happening inside of this range. And this is where many traders make mistakes. This range in here is external price. From this high to this low. Until we break out of this range, this is all internal price action. And so many traders get stuck and burn trying to sell internal structure. All you have to understand is that we are bullish, right? Let's say we had a break of structure, we're bullish. And so what you're waiting for is you can see price comes down into here and then price shifts internally. This is an internal break of structure, internal change of character. This is probably a range, right? A range before a breakout like this. And so price comes back into this range. This is your buy sign, and you try to buy and you target this high. And everything inside of here is simply just internal. This isn't an external higher high, it's internal. So what happens here? We have a high, a low, a higher high, a lower low. This is internal. Many traders look at this and they try to sell this level because they think that this is a change of character. But it's not, because price is always expected to go and trade toward the weak swing high. And so even if we sweep this low, this is a liquidity sweep, which is what I'll talk about to you next. This is a perfect area to buy from. And yet many people look at this as confirmation to sell, and that's why they keep losing trades. That's what we'd be expecting, this higher high in here. So once we break out of this box, that is our external. That's our real break of structure, like this. And now we need to find our structural low. And the easy way to do that is, we know that this is our new high. But where's our low? Our low is the lowest point that price retraced from this high before breaking structure. Again, the way you find the correct swing low is the lowest point that price reverses from this high that leads to a break of structure. So this is the swing low. Not this, not this, and not this. It's the lowest point before the break of the high. This is again a crucial thing that many traders get wrong when trying to trade market structure. This is the swing low. So now your new range is from this low down here and this high up here, right? So all you're expecting is price to come down somewhere in here, right? As long as it does not break this low, it is valid for a buy trade. Here's the problem though. Many traders again will look at this and they will think that, oh, look at this low down here. Oh, we break this level. We have a level of supply in here, let's short. And it's wrong, because you're trying to trade against the real trend. You're following a fake trend. It's this low to this high, price pulls back. This is a liquidation, perfect buy entry to trade higher. But many traders, again, they try to buy at this level, then they get taken out, then they try to sell at this level, and then they get taken out, right? And you've already taken 2 losses because you're trading the wrong side of the market. So let's look at real market structure in real time, and let's read each price swing. So what we have here is that price was bearish, right? and then it became bullish. We had a change of character in here. So we had a bearish break of structure, followed by a bullish change of character. Then we put in a high, and then we reversed. And then we put in a new high, which is a break of structure. So at that point in time, this is the strong low, and this was the high. Then what happens at this price point, right? Price ranges and aggressively expands toward the sell side, and that is what? A change of character. So then price shifts bearish, okay? So now price finds a new low, right? There's an area of supply up here. Not every single time does price have to hit that supply zone, don't forget, but there's a good area of supply in here, but price decides to trade lower. Then what do we have? Now we have a break of structure down here, a break of structure, a new high, right? And again, before we get there, now we have the bearish break of structure. And again, notice that we have a range before the aggressive sell-off, which is what? Your supply zone. And so you can literally just mark up this range, right? From the entire range, bring it across. That is your supply zone. That's your order block. That's the area you want to sell from. Your target is down here. Notice that we hit this level and we start trading away from it. We haven't broken the lows yet. We hit that level again and we trade away from it. That's how you know it's an order block, because every time that price tries to trade higher, it meets this level and this level blocks it and it trades away. They try again, blocks it. They try again, blocks it. And then if you go internal, what you'll see is range, expansion. So we have a range again, and then aggressive expansion. What happens? Price comes back up to this range and expands lower. Then what do we have? We have a larger range and expansion. So this becomes, again, our new area of supply. This is our swing high. So this now is our bearish order block. Notice what happens. This is now our low. All we're expecting is price to reverse from here and target here. We need to enter in here somewhere and exit down here. Notice what happens. Price reaches the order block. The order block blocks it going higher. They try again. It blocks it. They try again. It blocks it. Price cannot trade for that level. And so think about it. If you're a seller in here, right, and you put your stop loss here, you're protected because the market is blocking price from hitting your stop loss. Every time price is trying to break through, and it simply just cannot get there. And then again, what happens, right? Price breaks the lows. We have a range, aggressive move. This becomes your order block, an aggressive move again. And then finally, once more, now we have another range where price is kind of, and even on a micro level, look, we have range, expansion. Price comes back up to this order block, range, expansion, respect, continuation, range, expansion, respect, continuation. But also notice that you have range, expansion, respect, disrespect, range, expansion, respect, disrespect. So supply and demand is on both sides of the markets, but market structure is the glue that makes it so that you choose the correct side of the market, because supply and demand is an amazing concept. You can see here that all of these supply and demand levels hold at some point, but only the ones that are trading with the trend are the ones that truly prevail. Now, the third concept that I'm going to explain to you is liquidity, and I'm going to explain it in a way that will make so much sense to you. For the most part, everybody that talks about liquidity extremely overcomplicates it. And so we're going to understand it in the deepest way possible, but also it's far simpler than you actually thought. Now, just before we jump into that, if you are enjoying this video and you do enjoy the channel in general, do hit the subscribe button if you want more videos just like this one. And also feel free to leave a comment down below on what video you would like to see next. So liquidity, right? This idea that gets thrown out there left, right, and center that is really vague and nuanced. No one really understands what liquidity even means. And so first and foremost, before we get into the types of liquidity, what is liquidity? The truth is, liquidity is simply just money. It's money in the market. And the lifeblood of the market is liquidity. A liquidity for a market is like fuel for a car. A car without fuel will do nothing. It will not even move. Liquidity is the same thing for a market. It's not some special fancy term. It's just how the market operates. But the truth is, there is more liquidity in some areas than other areas. And the reason that liquidity is so important is because price needs liquidity to fill orders. So just like how we spoke in the beginning on supply and demand, how large institutions have massive orders, they need liquidity. So for example, if you was an institution, right, and you had, let's say again, 10,000 lots that you needed to sell into the market, it would be wise for you to sell those 10,000 lots in an area where there is also 10,000 lots worth of buyers. And there are some areas in the market where there are far more lots available than others. For example, the best liquidity levels that I know of are previous day's high. So if you literally take the low of yesterday and the high of yesterday, you have the previous day's high and the previous day's low. Very, very, very liquid areas. The other types are the internal session-based liquidity. So we're looking at Asia low, London low, Asia high, London high, and also New York low and New York high. These for me are the best forms of liquidity. And the second question you have to ask yourself is, how do we use liquidity? There is two types of ways you can use liquidity. The first one is what I call liquidity to take, right? It's LTT times 2. Liquidity to take and liquidity to target. So what you want to be doing is, if you understand the concept that institutions, they want to sell when price is trading higher and they want to buy when price is trading lower, you will understand that smart money institutions will manipulate price into certain levels where there is a lot of liquidity to transact their orders. For example, if you are a buyer, like we are in this market, right? We have a bullish market. We are a buyer. There is no point in buying up here because the likelihood is that when New York session opens, London lows are going to get manipulated. If you already know that, why would you try to buy above the London lows? If you are a participant inside of the London session, in this example, we're a seller, right? Price is bearish. We would want to be selling above the Asian session high, plain and simple, because that is where smart money can take price, because there is going to be a facilitation of demand in this area that they are going to be able to transact with to fill their orders. So if we're bearish and you want to sell in the London session, you sell above the Asia session high. If we're bearish in the New York session, ideally you want to be selling above the London session high, right? It's that simple. And then we have liquidity to target. So down here is, let's say, our previous day's low. Up here is our previous day's high. New York session opens, we sweep above London session high. We want to take a trade. We are going to trade into our previous day's low, into our London session low. And so it's as simple as, when you're bearish, the bearish liquidity becomes the liquidity you want to target. For example, right? Let's look at this price action right here. 15-minute euro dollar. One thing we can see is that the structure is bullish, right? The second thing we can see is that there is a range inside of the price leg, right? There's this range, which is a demand range, but there's also a micro range in here where price impulse, range, impulse. So this level here is also an area of demand. So New York session is about to begin. And what we can see here is that we have Asia session low. What we can see here is that we have London session low. So we're bullish, we have a bullish area of demand, and we have liquidity to take. This right here is the highest point of Thursday's price delivery. So this is Friday. So this is previous day's high. In here, we have an unfilled area of London high, unfilled area of Asian high, along with the trendline liquidity that's coming across this level. So here's what you want to look at. You want to identify all the liquidity points on your chart, every liquidity point that hasn't been taken. And you want to trade after the bearish ones have been taken and the bullish ones are to target. So what you'd be looking at is, let's take out London and let's head towards the bullish liquidity. It's that simple, because price is a magnet to liquidity. There's liquidity here. Price, if it's going to go in this direction, it's first going to take all of the liquidity in the other side of the market. And so price will play out. There's the liquidity from London. Now we are bullish and all of the liquidity that's on the sell side is gone. The only liquidity that remains is on the buy side, the liquidity that's up above here. And so you'll notice that price will slowly gravitate its way toward that liquidity. Price hits the highs, has a reaction. Again, because what's there? Price hits the next stem of highs. and has a reaction. There's no randomness involved, right? Price is intentionally reacting from these points because as price reaches above there are simply orders sitting at these levels. Notice now that price doesn't make it the whole way in this day. So now what we have is we're actually opening up a new week, right? Now it's Monday. So now we have the high of Thursday, but we also have previous day's high. So this is previous day's high, Friday. This is the high of the week. In a bullish price delivery, the previous day's high and previous week's high are massive targets to trade to. There is literally like a magnet pulling price toward these price levels. All you've got to do is figure out how to get involved. And so London session is about to open, right? London session is about to open. What do we have down here? We have Asia session lows in this vicinity. And so what you want to see is a sweep of all the sell side liquidity, a bullish reaction out. Now what do we have? Now we have Asia session high. So there's no bearish liquidity anymore. It's gone. The liquidity now is Asia high, previous day's high, previous week's high. And so you're trading the trend in alignment with the liquidity itself. And that's what you get, the movement into this. And it's a constant game of you find the direction of price, you identify the liquidity, you identify the supply and demand, you wait for the liquidity to be swept into the levels, and then you trade out of them and target in the opposing liquidity. No kidding, that is my strategy in a nutshell. In fact, I will walk you through now my step-by-step strategy on how I would have actually approached each of these trades, because these are live executed trades. So it always goes like this, right? Step one, if you've been here for a long enough time, you already know it. Market structure biased. That means I have to have a clear bias for market structure. It is very clear and obvious that in this scenario, I am bullish. Swing high, swing low, swing high. Very simple. That is my swing low. That is my swing high. So I already have my bias. That's step one. Step two, institutional supply or demand. In this instance, we are bullish. So we are just interested in demand, right? Supply does not mean anything to us right now. So it's institutional demand. We have two key areas. We have the first area, which you could use this entire range, which is a massive area of institutional demand. And then we also have the second load up phase where price expands out, we come back, we load up again, and we continue trading higher. Both of these levels act as order blocks. And so I want to see institutional demand so I know where to buy from. Step three, cleared liquidity. I want to make sure that before I'm taking a trade, that liquidity has been cleared. Because if I have not cleared the liquidity, I am going to be a part of the liquidity. It's plain and simple. If you're trying to buy too early before this London low gets taken, you are part of the liquidity. And so I wait for the liquidity to get cleared. My step four is confirmation. I'm bullish. I've cleared the liquidity. Now I need to wait for the confirmation. What I didn't add on here, in step three, is not just cleared liquidity, but also liquidity to target. I need to have liquidity to target. If there's no liquidity to target, there's no trade. I have London high, I have Asia high, and I have previous day's high. Huge, huge areas of liquidity. Step four, confirmation. What do I need to see? When price hits this box, I go from the 15-minute time frame to the 1-minute time frame. It's not difficult. I look at the market structure on the 1-minute time frame. What do you notice, right? I notice that when price is coming back to my box, the 1-minute time frame is very bearish, right? It's very clear to see. If we zoom into the recent price action, you will see that price has a low, puts in a high, has a low, puts in a high, has a low, puts in a high, has a low. It's trending bearish. When we get here, I need to see the market structure shift to go bullish. That's confirmation. That's key here. Then I can drop back to the 15-minute time frame. Once I've seen the confirmation, what do I need to do? The same thing, right? I find my range. Notice that price sits in here. Price sits here and has the expansion. Everything what we've already taught. We range, we expand. Now I have this. Now I can add my position. Entry on. My stop loss below the lows. And my targets. I can target here, here, and here. It's that simple. And then I wait for price to tag me in. Price tags us in. Price goes away, first target gets cleared. We have a reaction, second target gets cleared. Then the weekend comes. So now on Monday, now it's Monday. I'm still in this trade. Now it's time to add another trade. we are still bullish, right? Don't forget, we're still bullish. We're already reacting from the pro trend area of demand. So we're already protected here, right? We have expansion, contraction, expansion, contraction. Again, what do I need to do? Asia session low, liquidity to take. This liquidity needs to be taken out of the market. Then I need liquidity to target. Asia session high. This is previous day's high. This is the highest point of Friday's price action. Friday opens here at 5 p.m. It opens here and its high is up here. The previous day's low, which is here, isn't of interest because we are bullish. We do not expect previous day's low to be taken if we are bullish. We have this high and we have previous week's high. Notice that it is just standard logic that in a bullish market, the probabilities that we continue trading higher are higher than the probabilities that we reverse and trade lower, which is why every time you see a trend, it usually has multiple legs before it shifts bearish. So we are coming into the new week and we are expecting higher prices. This is literally an A+ setup. I wait for the lows to get taken. I wait for London to open. Let's take out these lows, because if you're a buyer before the liquidity is taken, you are the liquidity. Now the liquidity has been taken in London. What do? 1 minute time frame. Oh, look at that. To my surprise, the 1 minute time frame is indeed bearish. The final swings of the 1 minute time frame are right in here, right? Remove you. We have swing low, swing high, swing low. This is valid pullback criteria. We clear the highs. Oh, look, what do we have here? We have our normal range before expansion. That may just be my order block. If I go to a 15-minute time frame, that looks quite like my order block, right? And so you can extend it if you want to the 15-minute level. On a 5-minute time frame, it's a range and expansion. You set your trade, you set your stop loss. I'm expecting price to take Asia session high, previous day's high, and previous week's high. This trade is still on. This trade hasn't tagged yet. That trade tags straight back into the order block, straight away from price. And again, target 1, hit and reverse. Target 2, and target 3. Trading doesn't have to be difficult. But the problem is you're here on YouTube constantly looking at videos like this, concept strategies, and you're missing some other very, very important pieces, which again, I'm going to leave for you in the description down below. It's completely free. Enjoy.